Good debt is defined as money borrowed for things that can help build wealth or increase income over time, such as student loans, mortgages, or a business loan. Bad debt refers to things like credit cards or other consumer debt that do little to improve your financial outcome. There is very little chance you will be able to live your life without borrowing money at some point, whether it's for university, a house, or something else that you need. Logic has changed over the years. While our grandparents may say, "Neither a borrower nor a lender be," this is no longer feasible. We now live in a different world and need to be equipped with the tools that work. But, get debt wrong and it will cost you a fortune. You can't cancel your debts, so you need to get it right the first time. More people lead miserable lives because of debt than any other single factor. Credit cards do not give you free money. You have to pay back every penny you spend, and a whole lot more. Interest charges on credit cards can be extreme. Credit cards cost you nothing as long as you pay off all the balance each month in full. Set up a direct debit to do this and you never pay any interest. A credit card can be a useful tool. Used carefully, it can help you manage your finances and build your credit score. Avoid bad debt by spending intentionally but also by being a savvy shopper. Use useful tools like the Martin Lewis website MoneySavingExpert.com before buying anything. And use comparison websites that can quickly search to find you the cheapest price or the best quality product. Before you buy anything, run it by the Martin Lewis money mantra. Do I need it? Is it worth it? Have I checked if it's cheaper elsewhere? If not, don't buy it. Loyalty to a product or service provider is very rarely rewarded. What you will usually get if you are loyal to a company is a bad deal. Companies are not your friends by staying with the same company. Whether it's a bank, an insurance firm, or even your mobile phone provider, you will pay more. This is particularly true of home insurance and car insurance companies. Always get quotes from comparison sites between 20 to 24 days before the renewal date. This can save you hundreds of pounds. And only pay monthly if the additional charge is negligible. Before you start saving and investing, pay off any bad debt first. Then create an emergency fund with enough cash to cover at least 3 to 6 months' living expenses. You never know what's around the corner. This fund will stop you from going into debt if something unplanned happens. At some stage, you may want to buy a house and will have to take out a mortgage. When you look at taking out a mortgage, you will find lenders referring to loan to value, LTV. This is the size of the loan relative to the property's total value and is often expressed as a percentage. For example, if you are buying a house for £200,000 and borrowing £180,000 on a mortgage, this would be an LTV of 90%. If you can reduce the LTV by saving more money and using a bigger deposit, the mortgage provider will charge a lower interest rate. To get the best mortgage deal, do your own research, and then visit a mortgage broker. They should have access to the whole of the market and be able to get the best deal for you. Once you have your mortgage, should you overpay to pay it off early? This is an often asked question and the answer depends on you. Psychologically, you may feel it is beneficial to pay off your mortgage for the security this gives. But financially, you may make more money from investing rather than overpaying the mortgage. For example, if your mortgage interest rate is 4% and you can potentially earn 7% by investing, then the smart thing to do is to keep the money working for you. Paying off the mortgage early is a guaranteed return, whereas investing has some risk involved. You can find out more about investing and home ownership at gradragstoriches.co.uk, the #1 personal finance blog for graduates, showing you how to save and invest your way to wealth.